Imagine you're driving a car on a highway. The road ahead looks mostly clear, but you can see dark clouds in the distance. Now, what do? Do you slam the accelerator or do you maintain your speed and stay alert? That's exactly what Reserve Bank of India has decided to do. Hello everyone, welcome to this new edition of Sapphire Talks English. The RBI has decided to keep the repo rates unchanged at 5.25%. And now you may be thinking, but that's just a number for bankers to consider. But friends, think again. This one decision affects your home loan EMI, business loan interest, fixed deposits, stock markets, and even your future job opportunities. Now, here's something very interesting. Many economists are actually divided on this matter. Some expected a rate hike because oil prices have again become volatile due to the tensions in the Middle East. Others believe that RBI should wait. And RBI has done exactly that. It has said, let's not panic, let's first observe. It's a bit like Indian parents when they hear a strange noise at night. They don't immediately call the police. They first say, Ja bhai zara dekh kara. RBI has done exactly that. Let's first see what's actually happening. This is now another policy where RBI has chosen stability over surprises. But why? That's where the story becomes more interesting. So, why didn't RBI simply increase interest rates to fight inflation? This is because the Indian economy is currently sending out mixed signals. On one hand, India's growth remains among the strongest in the world. Consumption is healthy, infrastructure spending continues, manufacturing is expanding, and banks are lending well. On the other hand, the global uncertainty hasn't disappeared. Crude oil prices remain sensitive due to geopolitical developments. One major disruption in the Middle East can push oil prices even higher. And remember, India imports about 85% of its crude oil. When oil becomes expensive, transportation costs rise, goods become costlier, and inflation can creep back into the economy. And there's food inflation also. A weak monsoon or supply disruptions can quickly affect vegetable prices. So, RBI is essentially balancing two varying objectives. If it raises rates too early, borrowing will become expensive, businesses will invest less, people will buy fewer homes and cars, and the economic growth will generally slow down. If it cuts rates too soon, inflation may return. It's like making tea. Too much sugar isn't good, too less isn't enjoyable. The balance is what matters. That's exactly what the Monetary Policy Committee is now trying to achieve. Now, let's answer the most important question. How does this affect me? If you have a floating rate home loan, that's good news for you. Since the repo rate hasn't changed, your EMI is unlikely to increase immediately. If you are planning to buy a house or start a business, stable borrowing costs make financial planning much more easier. Now, what about fixed deposits? Most banks are expected to keep deposit rates broadly stable for now. So don't expect a sudden jump in FD rates either. Now let's talk about investors. Stock markets generally like predictability. Markets always celebrate higher or lower interest rates. They celebrate certainty. Banks, real estate companies, infrastructure firms, and NBFCs often benefit when monetary policy remains stable because businesses can now plan their financing more confidently. And here's something people often overlook. The RBI isn't working only for borrowers or only for investors. Its job is actually to protect the entire economy. Imagine a cricket umpire. If the umpire starts supporting only one team, the match is over. RBI has to remain neutral, it has to ensure inflation stays under control and economic growth continues. That's probably one of the toughest jobs in this country at this point. So, what should we expect over the next few months? The answer depends on several factors. First, oil prices. If geopolitical tensions push crude oil sharply higher, inflation could increase. Second, the monsoon. A good agricultural season keeps food inflation under control. A poor one can create the opposite effect. Third, the global economy. What happens in the United States, China, Europe, and Middle East doesn't just stay there anymore. Financial markets are all now interconnected. Fourth is India's own growth. If GDP remains strong and inflation stays within RBI's comfort zone, the central bank may continue with its wait and watch policy. But if inflation suddenly starts rising again, RBI still has the option of increasing rates. That's why this policy should not be seen as doing nothing. Sometimes not changing the policy is itself a powerful policy decision. It tells businesses, investors, and households that the central bank is confident enough not to overreact. And in today's uncertain world, confidence itself has become an economic asset. So, the big takeaway is this: the RBI has pressed the pause button not because the economy is weak, but because it wants to preserve the balance between growth and inflation, while keeping enough flexibility to respond if the global conditions change. So, friends, what do you think? Should RBI have increased interest rates to stay ahead of inflation, or was holding the rates the right decision? Share your views in the comment. I'd love to hear them. If you have found this video interesting, please like, share, and subscribe to Sapphire Talks English. We simplify economics, taxation, geopolitics, and geoeconomics so that everyone can understand them. Thank you for watching. I'll see you in the next video. Jai Hind, Jai Bharat, Vande Mataram.